Well, good afternoon, everyone. Again, Todd Nelson here with another 501 Biz Masterclass Zoom call. And these next three calls, we have Lance Mize. He is with Artifact Accounting, Artifact CPA Group. And we're going to talk about some issues that, Lance, I know this might come as a surprise to you, but very few people like to talk about tax issues. Um, but we are going to talk about it because it's such a huge portion of what it means to own a business. And we're going to focus on a few areas, not everything that has to do with taxation. But welcome, Lance, to the show. Tell us a little bit about yourself.
Sure. My name is Lance Mize. I'm a CPA. I've been in public accounting for about 22 years. I've worked with a lot of different industries, but I have focused on construction industry, the real estate industry, and logistics industries specifically, while also serving a lot of other small businesses. But in general, it's better to develop niches and
Hmm.
construction, real estate, and logistics in particular have, I guess, a little bit more technical tax issues that they face, whether it be at the federal level or the state level.
Hmm.
And that's where I felt like I've been able to add a little more value over the course of my career. And it allows us to develop special skill sets and bump into special transactions more frequently, such as the ones we'll talk about today with, potential liquidity events that hopefully come with the small business life cycle.
Yeah, yeah, awesome. So obviously, you know the format of these calls is we're going to keep it really short. So we're not going to obviously construe this as any type of tax advice or financial advice in any way, but it is talk about at fairly high level um, some of these. So we're going to get into our first topic. And one of the things I know that is big on and it was big for me when I sold my business, was the after-tax cash flow. When you're selling a business, what is that after-tax cash flow, and how does that all work when you are selling a business? Talk to us a little bit about that.
Sure. In this specific instance, and which I bump into, a few times a month, usually, just due to the nature of my work, you have small businesses who are trying to sell the company or a portion of the company. And
Hmm.
so, where I encourage them to reach out is where they get their first settlement statement proposal, often called an asset purchase agreement. Even if it's a
Hmm.
stock sale, it's off. There's asset purchase agreement, but then there's also the stock sale agreement, depending on the structure of the transaction. But what the document does is lay out the basic details of the potential transaction. You can kind of equate it to a settlement statement from a real estate transaction. This is just geared toward the actual business. What assets are being sold? Fixed assets, goodwill, territory rights, whatever they may be. Generally, they are defined and articulated and summarized within that document, and preferably they have values attached to each one of those asset classes within the document. And what that
Okay.
does, number one, it gives the owner a better understanding of what they're selling and how it's being valued. It also gives the tax advisor the information they need in order to prepare an after-tax cash flow analysis. So we've used that term a
Okay.
couple of times here. And what that really means is you sit down, you as the business seller, sit down at the table to sign the final documents to transfer the ownership to the buyer. And really, what most of those sellers want to know is when I sign on the dotted line and I walk away from this table after I've
Hmm.
paid all of the debt And after I've paid my taxes, how much cash am I really walking away from the
Right.
table with?
Yeah.
Which is a really important number to know. And
Hmm.
that's where I normally get involved, because usually I have all of the cost, the tax basis information in my
Hmm.
file. So
Hmm.
I'm able to say, okay, you're selling it for this amount, and you paid this amount at whatever period, perhaps depreciation and amortization over whatever period you've held the assets. And so you calculate the gain. And then, of course, you have to dig into the character of that gain. And there's often
Right.
ways you can tweak the agreement in order to gain some tax advantages, which we can talk about later. But the key thing I always emphasize to the client is that it's far better to know what that after-tax cash flow from the transaction is before you sit down, because it is, it is a frequent occurrence where the client will see the after-tax cash flow analysis and
Hmm.
say, you know what, I'm not going to do this deal. Or
Yeah. Sure.
I'm going to go back to the table and negotiate it differently, because I'm not willing to walk away from this operation with
Yeah.
this amount of cash in my pocket. It's worth more to me now that I see the after-tax cash flow. And
Yeah.
in one horror story, which thankfully was not related to me, I was brought in to help clean up afterwards. The client, well, they weren't a client at the time, but they sold a business for basically just enough to pay off the debt, and ignoring the fact that
Oh,
they
wow.
depreciated all of those assets, and that that payoff of debt really is income for the client, for the taxpayer,
Hmm.
and it
Hmm.
bankrupted the transaction. And it was a valuable company, but they didn't get any advice at the front end. They didn't realize they weren't going to be, not only were they not walking away with any cash, they weren't even walking away with enough cash to pay the tax, and it bankrupted the owner. So
Wow.
those are important aspects of the process to have
Yeah.
some understanding of before you actually sign on the dotted line.
Yeah, well, and we'll finish on this because next session we want to talk about some strategies to minimize those taxes. But so on the sale of let's say $1 million business, and there's some gain in there somewhere, hopefully, is that considered ordinary taxed at ordinary rate? Is it capital gains? What does that normally look like?
Sure. And I think we'll be getting into this a little later, but it can be, it's generally, the answer is both. As you'll often hear in the tax world, there's part capital gain and there's part ordinary gain. It depends on the asset being sold,
Yeah.
and the period that you've held the asset. But
Sure.
obviously the goal is to get as much of it classified as capital gain as possible to minimize the tax impacts. But
Yeah.
it's often both ordinary
I,
and capital gain.
and that's why, Lance, you'd make a good politician. The answer is yes and no. This,
Yeah.
a lot of our politicians are really good at saying that. Well, but that really is true in this scenario. So, really appreciate you joining us on this first episode, Lance. Next episode, we're going to talk about some strategies. Again, high level that maybe we can use to minimize some of those tax burdens when we do, for instance, sell a business. So, Lance, thanks so much. I look forward to seeing you on the next call.
Thank you.